Multi-time frame analysis is what we teach as our approach. It's like any approach, it's not infallible. And I say most of successful trading is what's between your ears. It's really about your approach to risk and managing risk. Just a point, I can have a tendency to speak too quickly. So if I'm speaking too quickly and you can't hear me or you don't understand what I'm saying, please ask me to slow down. Okay, so multi-time frame analysis, looking at, as it says, multiple time frames, at least 2, possibly 3. Some people call it resolutions as well as time frames. So we're looking at the dominant time frame, the higher time frame, and looking for entries on the lower time frame. Sounds quite straightforward, and it is, if you can, follow the rules. It's very straightforward. Okay, it's very much a top-down approach. Helps you to focus on the dominant trend, trail with the prevailing momentum, because that's what it's all about. It's all about momentum. Why fight something? I was born in a small village in the north of England, on the coast, and the tide came in and went out every single day, and there were some big waves and little waves. And trading is very much like the ocean. It never stops. Waves on the ocean never stop. The wind blows across the top of the ocean, creates waves, and they keep going. And as traders, we're always looking for that, the key wave or the key opportunity, and that's all. So don't waste your time and energy trying to fight, swim against the tide or fight a big wave. Go with the flow, go with the momentum, identify the momentum, and surf it into the beach, to finish my analogy with the beach. But I'll talk about waves quite a lot. It's just where I was brought up, and I live here on the coast here in sunny Cyprus as well. So higher time frame, sometimes 3 time frames. Support and resistance, very, very important, very straightforward. Smallest time frame for entry, higher time frame for marking these resistance and support areas. Okay, so it's very straightforward. Price points, pivot highs are historical turning points in price. So like any market, the financial markets, it's all driven by supply and demand. Once demand exceeds supply, the price moves higher. Once we get to a balance point, we roll over, and supply exceeds demand, the price starts to move down. And it's as simple as that. As I said at the beginning, I try to keep things simple. So don't complicate things too much. Don't overthink things too much. And the beauty of technical analysis, and the beauty of candles patterns in particular, is it can be very, very simple to understand. Put the right colors on your chart, and again, it becomes even simpler. So here we've got candles moving up. We've got higher highs, and then we've got to the top. We've run out of energy. We've got this high wick, and our 4th candle has rolled over. So we've closed here, but the 4th candle has closed here. So we're below our previous high. So we've got our highs lower than the middle high, the top high, and then the 5th candle confirms this 5 candle pattern. So we have this pivot high where it's created where the previous candles either side are lower than the pinnacle candle. So we have lower highs either side of our pivot high. And to identify that on a chart, it can be quite straightforward, or because they can, they jump out of you, especially if you've got these key moves and these key wicks that appear. So it's, it can be that straightforward. So pivot highs and support and resistance levels in an uptrend. So here we've got, say, the daily uptrend, whatever this uptrend is, whether it's a monthly chart or a weekly chart or even a daily chart. So we've got support and resistance levels being created by these pivot highs. So going back to my analogy about the waves, we've got this first big wave going up. We hit a point here, and then we roll over and we down. So the big wave runs up into the beach, and the backwash rushes back out, and we end up back here. So we've hit this point here, we've rolled over, we've created a pivot high here. Next wave is even bigger than the first one, so it breaks up through what was our previous resistance level, and we created a new pivot high, and the backwash takes us back here. So here we got a trend developing here, because the backwash has broken the previous resistance level, but not by very much. And then the third wave breaks up back through it again. So what was resistance could now become support, because the points we've hit here on the higher time frame have confirmed the trend, because we've had these 2 points hit here. So the third wave goes up, not as big as the first and second wave, little bit of backwash again, but it doesn't go back as far as this what is now support level. So fourth wave breaks up above our previous high, and on we go. So the trend is being formed here, and we have 1, 2, 3, 4 hits on our higher time frame in the lower time frame. So the pivot high is created at the top, and these pivot lows are created down at the bottom of as we hit the higher time frame. So resistance becoming support, resistance becoming support. The red line changes to a blue line as we move up in the trend. So we've identified a clear trend there, touching this trend line 4 times, and that's all we're looking for. It's great when markets are trending, but obviously markets don't trend all the time, 20 to 30% of the time. So, and again, charts help you identify these patterns and these destinations and these trends, and is it a trend or is it not a trend? Pivot low it's just the opposite. Okay, so we've got here with pivot lows, we've got the market moving down, supply greater than demand, buyers coming at this bottom at the end of the third candle. The sellers are exhausted. No, price won't go any lower. So the fourth candle moves us back up. Fifth candle moves us back up again. So just like with a pivot high, we had higher lows. Lower highs. Here we've got higher lows from the pivot low. So the candle 5 has created our pivot low. Lots of energy coming down. No more energy to take it any lower. Buyers come in and move the price back up. Okay, so either side of our pivot low, we've got these higher lows created by the candles either side. And so we go on. So in a downtrend, just like in an uptrend, we've got the same scenario going on. We have our wave moving down. We hit what is now resistance, and we bounce back up. Second wave down breaks through this resistance and creates a new resistance down here. And now what was resistance coming down now becomes support for our movement down. Excuse me. Okay, so it's the same principle. The higher time frame has created this downtrend we've identified, and we're looking for entries on the lower time frames to take these moves in for these pivot moves. So we're pretty confident as this wave moves back up here that at this point, well, we're not pretty confident at this point, I suppose it could go either way, but here we're looking for it to move back down this way. So we take our short position as we identify this pivot high here. So we're looking to go down here as we break this sort of resistance level here, and we move down again, a little bit of a backwash, another big wave, and we break this resistance level here this time, and we're moving down. So now our downtrend has been confirmed. It's been hit 3 times in the higher time frame, on the lower time frame, and fourth time we have the same situation here where this resistance level here has been penetrated, and it becomes support for our next move down. So we know it's not going to move any higher than that. We get our little pivot high here. The move up has been rejected at this resistance level, and now we're moving back down onto the next level. So here again, we've got a strong downtrend. 1, 2, 3, 4 times it's been touched on the trend line, and we wash our way down, as we say. We wave our way down, or we zigzag our way down. Movement, backwash, movement, backwash, big wave, backwash, big wave, backwash. As we move down, we zigzag down, confirming our downward trend. Okay, so I think I've got the wrong screen on here, haven't I? But never mind. Okay, so in uptrends, when the price pulls back to a former high, we're looking to buy the close to the level of this pivot. So we look for intraday signals. And in downtrends, when price retraces back to a former daily high, pivot low, we're looking to sell into the level of the pivot. We're looking for lower time frames as we're going down. Okay, so on the intraday chart, let's just have a look at it again. Let's run it through quite quickly again. So here we've got our daily trend. The intraday is hitting the trend. So we have the same scenario I've just been talking about. So we go up, resistance, bounce, retrace, next one, back through that resistance. So what was resistance is now coming support, confirmed by our higher time frame. So the intraday, whether it's 15-minute, 1 hour, 4 hours, is confirming our movement. So price pulls back to support, identified in the daily chart, and we move on again. These moves are sometimes reversed at pivot points, but often these reversals happen below the absolute. So as I say, this is an idealized chart. There's a few pips either way, and you've got to use a certain bit of a nous when you're looking at your chart to appreciate what's going on there. Okay, so we're moving up. We've got our pivot low here at the daily resistance. And so this is giving us confirmation to go back up as it's broken this level here. Next step up. Keeps us going. So we've had our 1, 2, 3, fourth leg up now. We've come back to the daily trend 3 times now. And the fourth one confirms us up. So off we go again. This breaks above the previous resistance and we're off and running. So lots of energy moving this forward. The retrace takes us back to where we were at our previous high, but breaks it or comes to it or it's close to it, doesn't break it sufficiently enough, touches it rather than breaks it. I call it sometimes a breach and broken before it breaks down. But here we've had a touch. It hasn't been breached, hasn't been broken, so we're confirming the uptrend still, and off we go again. We bounce off that key daily level on one of the charts that we identifying the intraday patterns on our candles, whether that's be 4 hour, 1 hour, or 15 minutes. Okay, so this is just a real life example taken from way back. It's 2014 when we put this. But so here we have the dollar CAD in a strong uptrend on the daily and weekly time frames. So here we've got covering from a 6-7 week period from the end of October through to the beginning of December. We've identified a strong uptrend, and we have a pivot high here at 114.28. This area here, 114.28 in green, 114.28, which happened to coincide as well from a technical point of view nicely with our 23% Fibonacci retracement. I'll talk about Fibonacci's today, but so there's whole webinars on Fibonacci's, and in fact I'm doing one I think next week on one of our sites about Fibonacci's. So additionally, we've also identified a triangle, and when trading with triangles, the technical theory is that the width of the triangle points to a potential high, and that's what we've got here. We've got our target of 115.44 created from this triangle if we break out of the triangle, and that's what we've got here. So this distance here has created our target from the breakout, which is here. So that's created our target of 15.44. So the question is, that's on our daily time frame. So the question is when to get in, when's a good time to take that is. So we're looking for corrections to the support level back to here. So we're looking, as this is running up, we're looking for a bit of a retrace to get us in on the intraday charts. So what are the intraday charts showing us? So here we've got the same, we've got the same target. We've got the target at 115.44, and we're looking for a retrace back to here. So here down at the 240 level, the 4 hour chart, we were looking for a retrace, and you can just eyeballing it, you can see there's clear attempt to break through the 23.6 Fibonacci level and even get to the 38.2. So that's a very strong, clear rejection of that movement down. Great big long wick to the bottom. Nice candle formation there, which would have got us in here at this level, and that's this is what's happened. So we've run up, it's retraced, it almost touched, got as far as the 38.22, but you can see here we got two Bollinger Bands set up on this particular chart. 2 deviations and 1.5 standard deviations, and the 1.5 standard deviation provided that support. So at the end, at conclusion of this candle, we bought here, and off we went through target, and then it kept going as well. And that was confirmed by this nice little confirmation in the lower time frame as well, creating this pivot low. So we've got a big indicator on the, we know the strong daily trend. We've returned to it on the 4-hour chart, drill down to the 1 hour or the 15-minute, and you see this pattern here developing, and that's a great indicator for getting in at this point here. Nice little hammer candle there, and a really, really strong hammer candle there, and that's what's happened. Okay, so target hit, and we moved up. You know, we can pull these examples up all the time, and so it is with going short as well. It's exactly the same theory. I won't run through this as well because I'd like to spend the rest of the webinar talking about the live analysis we've done this week and some trades we can take, and any questions you might have about any charts, any instruments you'd like me to have a look at, if anybody's interested in looking at particular currency pairs. So it's exactly with a lot of technical analysis, you just reverse the situation for short or long positions, and that's all you do here. Many traders speak to me and tell me they somehow they find it more difficult to short a market than buy a market, and sometimes that can be just due to the mindset, and that it's easier to understand things going up than things going down. But the beauty of trading Forex is that it is available 24 hours a day, 5 days a week, and it doesn't matter whether you can make a return, whether you're going up or going down. The old adage of buying shares and holding them, that you only make money with your shares if you hold shares if they go up in price. Going down in price doesn't help you, does it? So that might be the hangover from that. But short entries just the same as buying. And on the flip side of that, I have many clients that say they actually make more in shorting positions than in buying positions. So it's very much success in trading. It's very much down to you. It's very much down to your mindset, your acceptance of risk in particular, and being disciplined and being patient. All these technical indicators, all the services that are offered by all the brokers, they count for nothing if you haven't got the right mindset to be successful. And you need to find trading that fits in with your lifestyle, that fits around what you're doing, and that fits your personality. I've never really been a scalper. It doesn't fit my personality. I'm very much a day chart guy. I look at my charts at the end of the day, see if there's an opportunity. If there is, we take it. If there isn't, I don't. During the day, obviously, I'm looking at shorter intraday positions, but that's very much my personality. I check 30, 40 cross pairs every night, and say at the end of the day, if there's something's happened, there's a position to be taken, I'll make a decision and take it or not take it. I know my risk profile, I know my account size, I know how to trade lot sizes, and that's all those basics you need to really understand before you can move really forward with trading, regardless of anything anybody teaches you or anybody tells you out here on the World Wide Web. So multi-time frame analysis is one type of technical. Amir, that's Amir's just said here, not in my case, unfortunately. My personality is I win over long positions. Okay, well that's fine, Amir. It's each of us to our own. And we know, again, just getting off track a little bit here, but I have many people that find it easy to trade certain currencies than other currencies. Some people like to stick to gold and oil. They're very, very popular, and few people stick to that. I trade nearly 40. I look at 40 different charts. Other people will just look at 2 or 3 currency pairs or 2 or 3 assets. Or it's up to it. It's what works for you. And if you have a plan, you stick to your plan, you manage your risk, which is by far the most important thing when you're trading, risk management and money management. You can be successful doing this. And there's millions and millions of people trading online all around the world. So anyway, I digress, which I have a habit of. So I apologize about that, guys. So the down movement is exactly the same. I won't go through it in great detail. This is just an example from the S&P 500, the world's most important stock exchange. It was again, this is from 2014 when we first put these charts together. But we could bring this up any day. So principles exactly the same. Looking for a retracement, looking for the support in the higher time frame, looking for intraday entries on the lower time frame, 1 hour, 4 hour, 15 minutes, 30 minutes, whatever it is, and away you go. It's can be quite straightforward. So